So with that, let's go ahead and get started. I want to make sure everybody can see my screen, and you can. So once again, welcome. This is we have a webinar series. We've been doing a lot of different topics. This one is considerations for all Canadian citizens who own, live, work in Mexico. And so, if you fit into one or more of the own, live, work categories, I hope that the information that we share tonight will be helpful for you to make sure that you are in compliance with any requirements that would be on the Canadian end of things. And it is tax season, so it's pretty timely to be going over this. And it's something that, obviously if you need assistance with, Brad has been kind enough to join us tonight and go over the topics, and he is a certified accountant in Canada and can certainly help you with any of those needs that you have. We advertise this webinar in a lot of different forums. So I think I recognize a lot of the names online, but if I haven't met you yet, this is me. Hi, I'm Amber Pierce. I'm originally from Michigan, and I'm a graduate of Michigan State University who unfortunately just got kicked out of the March Madness basketball tournament, but that's a topic for another time. I have been visiting Port Morelos since 1998, and I moved to Port Morelos full-time in 2004. I'm the broker of Mayan Riviera Properties, and I'll talk about that in just a moment. But like I mentioned, webinars are one of the most favorite things that I do. So I enjoy being here with you, and I certainly appreciate your interest and everybody likes to talk about Mexico. If you aren't familiar with our company at all, I am the broker of Mayan Riviera Properties. We specialize in Puerto Morelos, Mexico. We do sales, real estate sales, we do vacation rentals, and we also do property management. I am federally certified by Conocer to sell property in Mexico, and also another certification to sell within its tourist zones. So because of that, I like these webinars. It helps keep me up to date on the most current information so that I can point people in the right directions to experts for their needs, because I do deal with a lot of foreigners that invest in Mexico. I'm a member of A.M.P.I, which is that green box on the left. That's the Realtors Association in Mexico, the Professional Association of Realtors here. I'm also an international member of NAR, N-A-R, and that is the black realtor box that you see in the middle. That is, Canadians probably aren't as familiar with that. That's the US version, professional real estate association. So I'm a member of them, and then also certified, which I mentioned, and that's the logo for that on the right. So what I want to do is, that is all the slides that I have until the end. I'm going to kind of wrap it up at the end, but I'm going to pass it over to Brad Berry. Brad Berry is with BDO, a professional certified accounting firm. He is Canadian, and he is pretty well familiar with the requirements that you all have as Canadians when you live, work, or own in Mexico. So what I'm going to do is, I am going to pass the baton, the presentership baton, over to Brad so that he can take it over from here. Brad, thanks so much for being with us tonight. I really appreciate your time. And so thanks so much for joining us.
Great.
And I'm
Thank you, Amber.
Yeah, you're absolutely welcome. And I'm seeing your screen just fine, so you're good to go.
All right. Hopefully everything stays good to go. Before I get started tonight, I do want to thank Amber just for giving me this opportunity to speak with everybody this evening, and for everybody for spending their Monday night with me. As Amber said, we're just going to be talking a bit about some of the tax issues for Canadians if you're looking at living, working, investing in Mexican real estate. I've also been told that I have about 3 hours to talk tonight. No, I don't think I have 3 hours. I think I was told about an hour. That said, I haven't rehearsed this to know if it's going to be exactly an hour. And again, if we do have questions, to be interactive, I think is fine, and make it as informal as we can. A bit about myself. I am a CA or a CPA now. I don't know what it is in Canada. We've been making some changes. And I've been doing tax ever since I got my CA. I was one of these people that got into accounting because I needed a job and then realized I didn't like accounting, and got into tax and specialized into tax in the early 1990s, and that's all I've been doing ever since. As far as what I enjoy doing, I don't like working with public companies. I work with owner managers and individuals. I find it a lot more satisfying working with individuals where we try to keep the equity that you've worked, hard and sacrificed for, and keep the government at bay where we can. Just a bit of a disclaimer this evening, just because this presentation is, I'm going to say, general in nature. We're going to cover a lot of material in breadth, not necessarily in depth. That if you're gonna, you shouldn't rely on this. You should use this in conjunction with your tax professional through any issues and compliance issues that you have to deal with. BDO, we are the 5th largest international accounting firm in the world. So not everybody knows that in Canada, but we are. So if you are going to look at actually moving to Mexico and living in Mexico, BDO is there as well too if you need help on the Mexican side. Now, I've been told we have a Canadian audience, and given that, I suspect that most on the call tonight will recognize that since 2015, there's been, I'm going to say, a lot of some significant tax changes in Canada, and it could be like many others. I've certainly run into a lot of clients that are certainly looking at leaving Canada, severing their ties with Canada, and ceasing to be a resident for tax purposes in Canada. If that is you, you're probably wondering, well, how do you go about this? What's all involved with doing that? In some respects, it's easy in that you just leave. However, when it comes to tax, it's not always that easy. I put in here, there's a form in NR 73. This is a form from CRA. I'll maybe flip through a few pages of it shortly here. This form is not required, but I would highly suggest and recommend that you at least work through the form so that you have an idea of some of the questions in that CRA may come back and ask if they do question whether or not that you've ceased to be a resident of Canada. If you do complete the form and you submit it with CRA, they will give you a determination on a basis of which to file. Canada does have a tax treaty with Mexico, so sometimes people get concerned, and there are countries where, well, what happens if I'm taxable in both states? Because we have a treaty with Mexico, you're not going to be deemed to be resident. Well, you could be deemed to be resident in both states, but the treaty is going to allow us effectively to be taxed in one state and not in both states. If you look at the form, you can see there's all kinds of factors to consider. When I'm looking at this, it's important that
Brad,
if you are writing anything, that it's clear.
Brad, I just wanted to break in to tell you, if you've got your form up, we still see your slide about determination of residency. So you might have to.
Yeah, I haven't got.
Oh, apologize. Okay.
And so, yeah, you just want to be clear. So here's the slide, and you very well may, unless you have a really large screen, you're going to probably have a hard time reading all of this. It is a pretty, I'm going to say, detailed form, and in some respects, it's not that detailed, right? I mean, they're going to ask you for just some general information, right? Do you visit other countries? You usually live in another country, but you enter and leave Canada the same day to work and shop. Well, a lot of these aren't going to apply. It's not like you're living on the border going back and forth between the U.S. They will kind of want to know, well, why are you leaving Canada? And they're going to ask you a number of other questions. They're going to talk about employment as well. Now, I suspect most of you're looking at more vacation and stuff, and so or retirement, and so employment may not be is big of an issue. They ask you about residency, whether or not you're going to be taxed in another country. So if you are actually going to live 8, 9, 10 months of the year in Mexico, yes, we're going to be taxable there. They want to know that. And I think the most significant thing is they want to know, what are your ties in Canada? And this goes through a couple pages, and you'll notice that they got tons of questions. Now, you don't have to tick all of the boxes. It's just the ones that apply. And it's really what is the most significant in your fact situation. Because they have questions on, well, do you have family leaving behind? Right? Well, yes, I'm going to go there. I'm going to retire there. I got 2 kids. They're not coming with me. Well, my 2 kids are, age of majority and working in Canada. They're not dependents. That's not going to weigh heavily. Whereas if I've got kids going to boarding school back in Canada, I'm going to Mexico, it may be a little bit different. And so I think, again, when we're looking at answering some of these questions, we just need to make sure that we're pretty clear and give enough information, in some respects not enough, depending on the outcome that you're looking at, because the last thing that you really want is to cease residency and then fill out the form, send it in, and they say, no, you're still a resident of Canada. So we need to make sure we understand why we're doing what we're doing when we complete these forms, and that we're not misleading as well at the same time. We need to be honest about these things. So I'm going to assume that you've completed the NR 73. CRA has determined that you are going to cease to be a resident of Canada. In the year you cease to be a resident of Canada for tax purposes, it's as if you died to the government, is probably the best way to put it in my mind. And in a way you did, in the fact that you're no longer, for the most part, contributing to the Canadian economy and to the government in form of taxes. So up until you cease to be a resident of Canada, you're still taxable on your worldwide income, just like any other year. And in addition to this, you're deemed to have disposed of capital property for proceeds equal to their fair market value. So this forces the realization of any unrealized gains and losses that you may have had. And this is similar to what would happen on death as well, too. So this can be an issue, because this deeming provision, there's no cash attached to it. It's not like an actual transaction where, hey, I've sold property and I got cash to actually pay the tax on the deemed gains that may be arising. So we don't necessarily have the liquidity, and so we need to make sure, if we are going to cease residency, we know, hey, if we've got issues for tax, what are they, where are they, and how much are they? Some of the more common properties that this provision would apply to is your principal residence, shares of a private corporation, other securities. Should be noted that when it comes to like pensions, RSPs, and RIFs, this does not apply. Now, for your principal residence, this generally isn't a big issue, as the gain is usually exempt from tax, but it should be noted that the disposition has to be reported. It used to be before 2016 that if you only had a principal residence and you sold it, gains not taxable, you didn't have to actually report it. They have changed the legislation on that, so you need to make sure that it is actually reported going forward. For shares of a private corporation, the issue that generally arises with these is the valuation. So you're deemed to dispose of something at fair market value. Well, how do you determine what the fair market value is? So that's usually an issue that you have to deal with. And the other thing is the status of the corporation may change. So in Canada, if it's a Canadian-controlled private corporation, generally speaking, first $500,000 of income you make, you get to pay a low rate of tax. And I'm going to say probably between 11 and 12%, depending upon in Canada where you are. Whereas if you're not a CCPC or a Canadian controlled private corporation, you get taxed at the highest corporate rate, which probably puts you in around the 26 to 28% tax rate for corporations, depending upon where you reside in Canada as well too. So you want to just make sure you know what's going to happen because of the gains. And so if you do own shares in a private corporation, you do want to cease residency. It's important that you plan for that, so you know, is there planning that could be taken to mitigate the taxes, yes, there is. You can actually look at some planning which would effectively devalue the corporation and the shares, not necessarily that you're going to lose anything, but devaluing it for tax so that you don't have as big of a tax hit going out. In some cases, when you're looking at securities or other more liquid capital assets, sometimes you may actually want to consider selling it and reacquiring the securities and actually triggering a real gain. And then you have support in the form of paper from the trades to support a higher cost. Because generally when you go into another country, the question's going to be, hey, when I sell that, well, if I'm resident there, I got to pay tax on those gains there. How much is my gain? And so that just kind of simplifies things. I know for between Canada and the US, it's probably much more important than between Canada and Mexico. And again, there's no immediate impact on your pensions, your RRSPs, but you really need to make sure that whoever's administering those for you knows that you've ceased to be a resident of Canada. And the reason for that is just that there's going to be withholding requirements when you do make distributions from those plans, and they'll need to know that they're doing it at the correct rate. So if they know you're non-resident, but they don't know where you're at and they don't know it's a treaty country, they're going to be withholding 25% of the gross proceeds. Otherwise, it could be like 15% of the gross proceeds. Now that you've also ceased to be a resident of Canada for tax, you're probably thinking that, hey, finally the government is, got their hand out of my pocket. But I think you still have to, not get too excited, because depending on your personal situation, there still could be taxes that are payable in Canada. So if you still have some type of employment in Canada and you're earning that employment income in Canada, so let's say you come back and forth every so often, that employment income would still be subject to tax in Canada. Same would apply with sort of business income. And the other one is the dispositions of what's referred to as taxable Canadian property, which is really, for the most part, real estate, or it could be shares of a corporation which derives most of its value from real estate that's situated in Canada. And so when real estate in Canada is sold, that gain is still subject to tax. And so if you go back earlier, I said, hey, we got the deemed disposition of your principal residence. We want to make sure we report that. Okay, how can we support, in my mind, the highest value possible, knowing that if I'm going to sell it 3 years later when I'm not, that deemed disposition sets my new cost for the future gain when we do dispose of it, which is still subject to tax in Canada. And we'll talk a bit more about that later as well. Now, I think what may be a more common situation is that you haven't actually ceased to be a resident of Canada, but you spend considerable time in Mexico. And so you might be in the opposite side of things. You might actually be down there and actually have some employment while you're down there. And if that's the case, the employment income you earn in Mexico is subject to just a withholding tax. And my understanding is it's like 15% or 30%. And I'm not exactly sure if it's based on how much you make or not, but it's just a straight withholding tax. And they consider that final payment for your taxes. And so no Mexican tax returns actually required to be filed. Now, since you're still a resident of Canada, you're taxable on your worldwide income. And so that would still include the income that you earned in Mexico. And if we remember, oh, well, they withheld tax. Let's say it's 15%. Well, we have a treaty with Mexico, as I stated earlier. And because we have that treaty, it's going to allow you to claim a foreign tax credit for the Mexican tax that would have been withheld at source. So you don't pay tax twice, but what it really does is it forces you to pay the higher tax of the two different countries. So in Canada, might be, oh, I got to pay 30% tax. I paid 15% to Mexico already. You're only going to pay 15% tax in Canada, but your total tax would be 30%. So I'm not sure if that makes sense or not. That's kind of how that would work. The issue with the employment income withholdings on the Canadian side is that CRA, more times than not, when foreign tax credits are claimed on a personal tax return, they ask for evidence and proof of the foreign tax that was paid. So they want to actually see something. In CRA's mind, what they're looking for is they're actually looking for a Mexican tax return that was filed and they're going to want something from the government that assessed it, just, because they don't believe that just because you did the return that you actually filed it and paid the tax. And they're going to say, okay, based on this, you get a foreign tax credit. But if it's just withheld at source, you're not filing that return. So you want to make sure that you keep any paper to support the amounts that were claimed, so that you don't have to deal with CRA if at all possible. Again, if you did cease residency and you're in Mexico, it's almost the opposite, right? Mexico still taxes on worldwide income. So if you have employment income in Canada still, resident of Mexico, the same thing would apply. The only difference is in Canada, while you still have withholding taxes, you're still obligated to file a Canadian tax return, unlike in Mexico where you wouldn't have to. Now, most are probably here this evening wanting to talk more about tax in the context of real estate. So for residents of Canada purchasing property in Mexico, it's generally going to be used in one of two ways. One is that's just solely a personal use property, or it's a rental property or a combination of those two. As discussed earlier, if you're a resident in Canada, you're taxed on your worldwide income. So any rental income will be subject to tax in Canada and reported on your personal tax return in Canada. Now, since the property is in Mexico, the Mexican government is allowed to tax that. They're actually allowed to tax that first, if that makes any sense. And that's common in most countries, and certainly with all the countries that Canada has a tax treaty. So as a non-resident of Mexico, you're going to be taxed in one of two ways on the rental income that you're earning. One is a straight withholding tax of 25% of the gross rent. Now, this is likely to result in the most tax of the two options that you have, but it is easy. And if you're, don't want headaches and you want to keep things simple and you're not looking at a lot of rental activity anyways, that certainly may be the easier route to go. The other option is to actually file a tax return and pay tax on the net rental income. This would allow you to have deductions for like management of property, maintenance, insurance, property taxes, and such, and then you'd pay it at their graduated rates in Mexico, which go from as low as like 2% to 35%. So practically, you should file on the net basis if you're planning on claiming foreign tax credits in Canada, though. So you might say, you know what, it's not worth my time. It's a headache. They can withhold 25% of the gross rents. And then you go to file your Canadian tax return, you want to claim your foreign tax credits. As I said earlier with the employment income, they want support for the foreign tax credits. Now, with the wages, the withholding tax is considered final payment of tax. And when it comes to rental income, because we could file on a net basis, and if filing on the net basis would result in a lower amount of foreign tax, it's the least amount of foreign tax that you're obligated to pay that you can claim a foreign tax credit for. So if you want to claim foreign tax credits in Canada on the rental income, it practically forces you into having to file in Mexico on a net basis. One other thing, Mexico does have a VAT, their version of GST. It's separate and apart from income tax. And there's also some states that are also allowed to tax income on property as well in Mexico that you have to just be aware of. Now, assuming you're purchasing property in the restricted zone, you're going to be purchasing it through this is where I need Amber to help me out, for the casino. I don't know how to pronounce it. My Spanish is poor and embarrassing.
That's okay.
So I'm going to refer to it as a trust.
There you go. It's called the fideicomiso. Fideicomiso, but you can call it the trust and everybody will know what you mean.
Yeah. I'm gonna call it a trust because from a Canadian perspective, it's a trust, and it's the trust rules up here that we have to deal with. So when I'm taking a big, huge leap, and presumably the funds to buy the property are coming from you or you or your spouse, or a combination of the two of you. And I'm also making an assumption that the beneficiaries, or those who are allowed to use the trust property, would be like yourself, your spouse, potentially your children's. So when we're looking at establishing this trust, it is under Mexican law and legislation that this is set up. And so you have some options. So my understanding, based on some discussions I've had with Amber and that as well, is, you can name others. So you don't have to have just you and your spouse as beneficiaries. You could add children's. You could even add corporations as beneficiaries, and you can presumably make them contingent so they become a beneficiary on your death. So there are requirements that need to be met. So I think the trustee in these situations has to be a bank in Mexico and stuff. But they are going to have Canadian tax consequences. So in Canada, these trusts, in most cases, are likely to be deemed resident trusts in Canada. And I'll probably talk a bit more about that in a little bit. But because they're deemed resident, we have to kind of figure out, well, what are they under Canadian tax law? So in Canadian tax law, when we go back and say, well, wait a minute, I'm buying a property, I'm putting the money in, I'm going to be a beneficiary of this trust, we're really looking at one of two different types of trust: a reversionary trust, and one's known as an alter ego trust. An alter ego trusts are trusts where the person who put the money in to buy the property is the sole person who has the right to all of the income for the trust each year, and no one but that individual can have a right to the capital or the assets of the trust while he or she's alive. Now, it's also possible to set this up so it's between spouses, and you're just looking at sort of the joint last to die type of a scenario. And with an alter ego trust, it's possible to transfer the assets in. So they're kind of funny. You got to be 65 years of age or older, but you can transfer property in on a tax deferred basis. Now, in this case, because we're probably putting money in to buy a property, it's tax paid assets already, so there's really no benefit to that. So it's not really something in my mind that is advantageous in this situation. Now, they are taxed like every other trust. So in Canada, you're just taxed at the highest marginal rate to the extent that there's income in the trust. And because of that, we don't ever leave income in trust. We push that out to the beneficiaries. And so if we set up an alter ego trust, any rental income that the trust earned would be taxed in your hands personally on an annual basis, as though you owned the property directly. The other thing with an alter ego trust is there's a deemed disposition of the assets of the trust immediately before death. So if I died tomorrow, basically at the end of the day today, I would have had this deemed disposition. And so what that forces you to do is take any unrealized gain on the Mexican property. Here's what the gain is, and it would be taxed on my final tax return. So it forces that deemed disposition. The other trust is a reversionary trust. And this is a trust where the person who creates the trust can either be entitled to the capital or the income of the trust, or determine who does get it. Now, in this case, you have in theory, a Mexican bank is a trustee, but if you're a beneficiary, you could be entitled to it. So in some respects, it looks very similar to the alter ego trust in that any income that it earns is still taxable to the individual. But where it's different is there's no deemed disposition. So if you died tomorrow, nothing happens. Presumably the other beneficiaries are the beneficiary of the trust. And if we sold the property 3-5 years later, the gain would be taxable to them, and we avoid this deemed disposition rule. So Depending on, if you're over 65, you have an option between the two different trusts. Obviously, if you're under 65, you're looking at this reversionary trust scenario. Now, since you have to use the trust to acquire property in the restricted zone, you're going to have filing obligations. Now, some may have bought property in the past, and you're probably saying, what are you talking about? I've never filed any trust returns. What's really going on here? In 2018, so February 27th of this year, in the federal budget, they did change a lot of the rules dealing with trusts. And so starting in 2021, pretty much all trusts are going to have to file tax returns, whether they're taxable or not. Now, again, you're probably saying, wait a minute, this is a Mexican trust. What are we talking about filing a trust return in Canada for a non-resident trust? And again, because these deeming rules, and the biggest one is that we've got a Canadian who has transferred property to this foreign trust, which will deem this trust to be Canadian resident trust. So even though it may not be subject to tax and that it's generating no income, going forward, CRA, or based on finance and their legislation that's been proposed in February, is that they're going to start subjecting these trusts or any trust to a late filing penalty of $25 a day to a maximum of $2,500 for late filing it. And then they also added this gross negligence type of a penalty as well too, which presumably would be, if you're a repeat offender and other things, that they could assess a penalty of 5% of the maximum fair market value of the property of the trust per year. And so they're getting a little bit more serious with penalties in Canada. In the past, they haven't been, but when I'm looking at that, these are the situations where we just want to be careful, especially for those that have had property in the past and maybe have never had a filing requirement that they're going to. The one other thing that we want to be careful with is foreign reporting. Foreign reporting is, I'm going to say, overlooked a lot in Canada by Canadian taxpayers. Some of it's because we just don't know when and where we need to report it, and sometimes it's not necessarily that obvious. And in other cases, it's just, I'm going to say, maybe potentially ambiguous. So with the trust, the foreign reporting issue that we can run into is for foreign ownership. So if a taxpayer owns foreign property and its cost exceeds $100,000 Canadian, we could be in a situation where we have to report this on a form T1135. Again, you'll notice I put in penalties here, $25 a day for $2,500, then they go from that to $500 a month, or, to a maximum of $12,000, and then $1,000 a month to $24,000. And then they have this 5% of the cost of fair market value, the property penalty there as well too. And that's separate from the penalties for late filing the trust return. I did put in here, just so you can see it, a copy of what the form would look like. It's not a complex form. There's not a whole lot to it. It's some information. They do ask two different questions. One is if the cost is between $100,000 and $250,000, we complete Part A down here. If it's more than $250,000, we complete Part B. And really what would apply is there's this thing with real estate. And so they're saying, hey, do we own real property outside of Canada? If we do, and it costs more than $100,000, we might have to report it. And I say might because they say other than personal use property, if you can read through there, other than personal use property or used in an active business. So when I said earlier that we've got potentially personal use property, and here it is on Part B. They just want a little bit more information if it's under Part B on the cost and fair value. We have this filing obligation. Now, is it personal use property? One of the things I said earlier is we're probably buying it, and it's either personal use property or it's going to be used for rent, or it's going to be a combination of the two. From a personal use perspective issue, we're generally looking at I'm going to say a more than a 50% test. So they say, they use this word principally. So in the Income Tax Act, they'll use a word principally sometimes and primarily. In both cases, that generally is implied to mean more than 50%. So if I have a personal use property and I use it primarily more than 50%, personally, it's personal use property, I probably don't have this filing obligation. But what if it was not personal use at first and it becomes personal use? Do I do my 1135 reporting this year, not next year, maybe again the next year? And the issues we run into are situations where it might be, it's going to be vacant some of the year. So if it's vacant some of the year, are those vacant days personal? Are they non-personal, or are they excluded? And so we can get into issues where it can not necessarily be as clear as you think. And given the penalties in that, if there is some revenue from it, it's not going to hurt to file it. So if we're not totally sure, but we think we could be in that position, you're probably better off filing it than not filing it, and then you don't have to deal with disputes with CRA over penalties, whether or not they apply or don't apply. I do have a question here right now talking about if your Mexican property market value is less than 100,000 Canadian. Now, the question here is not really market value, it's actually the cost. So when you actually acquired it, what is your cost in Canadian dollars? And so we have to go back and say, well, what was the exchange rate when we bought it as well too? And what did we pay in Canadian dollars? And so if I paid $101,000 for it, I potentially have to report this on the 1135. If that market value dropped to 80,000 Canadian, I still have to report it because my cost was more than $100,000.
Brad, there's actually another question too. Thanks for answering that. And that is, and this goes back a little bit to what you were talking about as far as residency goes. And the question is there any conflict on the Canadian side to be, a tax resident of Canada if you have your temporary or permanent resident card of Mexico?
Well, we can talk for an hour on residency. You can have a card, but that doesn't necessarily mean you're resident for tax.
Exactly. Okay.
Right. And so again, if we went back to that NR 73 and you go through, they're trying to find out where you're more closely connected, right? They have this concept of, in the US, if we're talking in the US context, they have a closer connection election, right? And so the whole idea here with the treaties and what they're trying to determine is where are you most closely connected, right? So I'm in Mexico, but I still have my Canadian health care. I still have my Canadian driver's license. I still have, my membership back at the golf club. What they're looking at is where are you, as opposed to situations where, I have a client that, moved to the US, right? On a work visa. He's never coming back to Canada. There's no ties to Canada. So even in a situation where it's like, well, wait a minute, you've got a temporary work visa, there's no guarantee that you can stay. All ties were severed. Doesn't have health coverage in Canada, doesn't have a driver's license in Canada, actually hasn't been back to Canada in probably 2 years. And so we really got to go through that. And there's, at the end of the day, it can get complicated, right? I'm a
Sure.
Canadian citizen, but I got status in Mexico. I got a house in both countries. And you can get to a point where you actually have to go to competent authority between the two governments and let them decide.
And let them decide. That makes
And
sense.
so
Yeah.
so when I'm looking at these things, again, if we're filling out the NR 73, well, what do we want? Do we want to be a Mexican resident or a Canadian? And when you're going through that, you can plan a bit, right? It might be, well, you know what, we should keep this, and this if we don't want to cease residency. Or, you know what, if we want to go, let's get rid of this, and this, because optically it's going to look a whole lot better.
Sure. That makes sense. Thank you for answering that. There's another question. Oh,
and
sorry, go ahead.
no, I'm good.
Okay. So there's another question that they chimed in with, and this is one that's a little bit more recent in the information, and that is this form that you've been discussing, the T1135. They have a fideicomiso,
Mm-hmm.
right? The trust. They own it in trust, but they don't rent
Yep.
their property. And I think you touched on this a little bit, but just to be sure that we've got it clear for them, regardless or not of whether they rent, are they required to still file that form? So in other words,
No, because
no
when you
income on
go
it.
through
Okay.
that, no, and it's again, they talk about other than personal use, right? So
Mhm.
it's that personal use thing that catches us, right? So here it's only personal use, it's excluded.
Gotcha. It's
So if you've never rented it, and that's where you get a lot of situations where nobody's filed a trust return in the past because they don't have any income from it, right? And there's no foreign reporting required because it's personal use property. And so nothing's been filed, right? And I think the
sure.
important thing there is just to know come 2021, you're going to have to start, filing tax returns. There won't be any tax owing on it, but you probably want to start filing this to make sure that you are compliant because the penalties could get significant.
Gotcha. And then we just for everybody as we continue, there was a couple of people that chimed in. There was some background noise, and I just wanted to know I muted everybody off, so I think we've got it. We're good. So thanks so much, Brad. Continue. Thanks. This is great.
All right, where did we leave off? Oh yeah, personal return. So when you're filing your personal return, uh, there's probably a couple things that you probably don't want to overlook, and one is with regards to rental income. As we said earlier, if we're resident of Canada, we're taxable on our worldwide income. Yes, there's a trust that owns the property, but I know that how it's going to be set up, whether it's an alter ego trust or a reversionary trust, you're going to be deemed to have earned that income personally. And so we'll just want to make sure that that is actually reported on your personal tax returns. Now, it's kind of interesting because we talked about the 1135 in the previous slide, with the ownership, and that's because the trust owns it. And so again, we won't have an 1135 filing requirement personally because it's actually a trust that owns the property. Now, there are other reporting issues with trusts in the Canadian side, dealing with non-resident trusts. And again, this is where it gets a kind of, I'm going to say, confusing in some respects because we're filing a Canadian tax return for these trusts. We're deeming it to be resident of Canada. And now Brad says, oh yeah, but you made a transfer to a non-resident trust, right? And so there's more foreign reporting, and I listed the forms here too, a T1141 and a T1142, which is just information. It's information trust, and I can maybe look at one of these here in a second too. we're supposed to disclose it. If we take money out, we're supposed to disclose it on these forms. The penalties on these forms are very, very similar to the penalties on the 1135. And so if we haven't been doing them, the question is do we go back and say, oops, and ask and beg for forgiveness, which we are allowed to do in Canada. Now the 1142 is general distribution, so the money. This 1142 hasn't even kicked in yet. The 1141 might have kicked in, and where I think there's potential issues with the 1141 is they talk about transfers to a non-resident trust, and in most of these cases you have sort of annual operating costs and that we're paying personally. So if I'm paying it personally, am I actually making a transfer to the trust because the trust owns the property and is paying these things? Or am I just paying that outside, and it's almost like I'm going to say I'm paying rent by paying costs. So we're not making any rental income, so to speak, on a net basis. And I think that's just something that you got to work through and make sure that you're comfortable with, especially if you haven't ever been filing 1141s, which I suspect most people never have or even think about it. I'm going to talk a little bit about use of your principal residence exemption. Most people know in Canada we don't pay tax on the gains on a disposition of our principal residence. What you may not know is that your principal residence doesn't actually have to be in Canada. So your home in Mexico could qualify for a principal residence exemption. And whenever I'm looking at foreign property, quite often people think, oh, I don't have a huge gain. But then you actually start looking at, well, yeah, but what was the exchange rate when you bought it, and what's the exchange rate today? So the property in the domestic currency may not have a huge gain, but we could end up with a large foreign exchange gain that's kind of built into that property for us. And so our gain could be more or less than what it appears, right? Because we don't always think that, well, what was it 8 years ago when I bought the property? With the capital gains exemption, if we've got more than one property, we always want to claim it on the property that has the largest gain on a per year basis that you've owned it. You just get the best bang for your buck out of it. So again, a property outside of Canada, it can qualify for your residence. A taxpayer's resident in Canada and owns the property can designate it. So the issue we have is you don't own the property. The trust owns the property. Now, it is possible for a personal trust to claim the principal residence exemption. The normal rules as far as, living in it, occupying it, and that doesn't have to be on a full-time basis. So most vacation properties would qualify. We can do it. Now, they changed a bunch of legislation in 2016 with this. So no longer can any trust make this designation. For our purposes now, it would have to be an alter ego trust. A reversionary trust before 2016 could have made the election, but it can no longer make that election going forward. So if you bought the property and you were not 65 at the time, I know it cannot be an alter ego trust. You're not going to be able to make this election. If you were 65 when you set it up, it might be worth going back and looking at the terms of the trust when it was set up to see if it's an alter ego trust or a reversionary trust. And you might be able to claim it. They do ask for a bunch of information. If you are going to claim it, there's an election form that needs to be filed. It's the same one that you'd have to file if you were filing your personal return and claiming the principal residence exemption. And they want to know who's beneficially interested in the trust and who ordinarily inhabited it. And so the idea here is if you're down there inhabiting it and your kids are down there inhabiting it, they're going to make everybody use a principal residence exemption. So again, if it's just mom and dad that fall under here, well, they only get one exemption themselves. It's not costing us anybody else's exemption that we might want to look at doing that. But again, I think what's interesting here when I look at this is it has to be an alter ego trust. And if we go back earlier in the presentation, I said, you know, with an alter ego trust, immediately before you die, you have a deemed disposition of this property, and we got to pay tax. Whereas a reversionary trust, we don't have that. It just, the trust continues on, and you're just no longer a beneficiary. Now, I get into this, and I know a lot of people, especially in the U.S. context with the state tax and stuff, say, well, yeah, but you know, well, what happens if something happens? Well, you have to die for it to trigger, right? You know, if you're sick or you're not going down there anymore, you can just sell the property, and you know, it's just a disposition like anything else, and not necessarily anything adverse, but it's certainly something to consider the difference between the two trusts. All right, so now let's say that we have ceased to be a resident in Canada, and you kept your house back home, right? Because I think the other thing here is if we do leave, we have to realize if we've got property back in Canada, most likely your old principal residence that you didn't sell, you might be renting it out. Well, if we're going to rent it out, we're going to have withholding taxes. So kind of same thing that we're talking about in Mexico. If we rent it out, we get withholding taxes. Canada is no different. And it's very similar in the fact that, hey, you know what? We can withhold on the gross rent, or we can withhold on the net income. The difference is there's a lot more compliance on the Canadian side to get to that point. So if we want to remit on the net basis, you actually have to have like an agent or manager of the property. They got to go call CRA and get a non-resident account number for you. And then they got to fill out this form. It's just an NR6, which allows them to withhold on the estimated net rent as opposed to the gross. And then they have to actually withhold that tax, and they have to remit it. And depending, it's basically they have to remit it on the 15th of the month following the month that they received the cash. So you might have charged somebody rent, but if you didn't actually get it yet, the withholding isn't due. But assuming you collect rent on the 1st of every month, on the 15th of the following month, they'd have to remit that. Then they end up having to report that almost like for a T5 or a T3 that you'd get for your Canadian taxes. It's an NR4, but it has the same thing. Here's the gross rent, here's the tax that was withheld, and then you thought you were done, but you're not. You still have to file a Canadian tax return, report your net income from the rental property, and depending on your withholdings, you either get a refund or you have to pay it back. The other thing is, you know, if that is the case and you sell the property, the one thing I'm going to point out here is that if you're not a resident of Canada, so you've ceased, but you haven't sold, you know, your principal residence or other properties back home, when you do sell them, there's this form, it's a T2062, which I listed here. You actually have to file that with CRA within 10 days of closing. And failure to file that one subject to a penalty of $25 a day to a maximum of $2,500. And it will allow your lawyer or attorney to withhold 25% of the net based on the net gain, as opposed to 25% of the gross proceeds. So the form basically goes through, here's what we're selling it for, here's who we're selling it to, here's the price, here's our cost, here's my gain. We want to file it on the net basis. Again, we end up filing a tax return at the end of the year, report the gain, here's the withholdings. And it sounds like it's a pain, and it is a pain. These forms, once we file them with CRA, take months. So that your attorney here gets proceeds of disposition. He's sitting on 25% of it. And meanwhile, we're waiting for CRA to assess this form, send it back. Once we get it back, we get a couple of copies. We get one that we send back the remittance with. And then after that, the lawyer can release the net proceeds that might have been there. So that's all I had. I do have some other forms in here too. I know that you can get this presentation afterwards if you actually wanted to look at, hey, what's the 1142 or if you want to look at it now, I can find it for you now as well too. Most of these they're not complex in the fact that there's not significant calculations, if any at all, that are required on a lot of this. A lot of it's just information and facts that they are looking for. So I don't know if anybody has any questions. I was told that after about an hour I'm going to lose everybody, so I'm going to try to keep it to that, but certainly stick around for any questions that anybody may have.
Just as a reminder, thank you so much, Brad. Just as a reminder, if anybody does have questions, you're welcome to write them into the chat box if you don't have audio, or tap that microphone button. It'll turn green and your mic will be live and you're able to go ahead and ask. Are you guys good? Are there no questions? Brad, you might have covered everything very well. It doesn't look like anybody has any questions. I'm looking. Susan says, the short answer seems to be, I love Susan for this. She has a great sense of humor. Short answer seems to be, I hire a tax accountant and or a tax lawyer. And it's funny because that's sort of the conclusion that, Susan, don't feel you're alone. We had this similar discussion with the US side 2 weeks ago. And oftentimes, as Brad has indicated, there's a lot of sort of between the lines on some of these forms. And I wouldn't disagree. As he said, the calculations aren't difficult, but the potential outcomes of some of those responses, depending on where you want to go with it, could definitely have consequences, right, Brad? I mean, it probably would behoove people to have a professional sort of guide them on this rather than just winging it in some cases.
Yeah, and I think sometimes it's just an initial thing. Like with these trusts, if we know the legislation's changing, if we know we're going to have a filing requirement, but it's going to be like a nil return, once the initial return is filed, where they're going to ask for, basically they're going to want to see the trust document. They want information on who created it, who's the beneficiaries, everything else. Once that's done, the reality is if you wanted to find the forms off the internet and file a no return on an annual basis after that, you're probably fine doing it.
Mm-hmm.
I think it's more the, hey, before I do this, what issues do I have? And I think knowing what those are, because quite often it's easy to plan going into something. It's very difficult to fix something after it's been done.
Sure. No, that's a really, really good point. I wonder, as you were talking about that, the U.S. took very similar steps, and I realize that, it's not always analogous from country to country, but originally, as all these countries are trying to get their arms around sources of international funds for whatever reason, right? For taxation, for money laundering, for all of the, in the US, there was certainly, Homeland Security wanted to know. And in the US side, they required us to file a form for our Mexican fideicomisos because it was under a trust, the same way Canada is now doing it. It's a trust, so therefore you have to report it, and there was a form. And then several years later, the US government actually said, the trust in Mexico is really just an envelope to hold a deed. It's not really a trust in the sense that we recognize trusts as you were mentioning, right? That there's not money coming in and out and flowing through. And therefore, down the line, they actually said, Mexican fideicomisos to hold real estate don't count. You don't have to file it. But it took them a little bit of time to kind of work that out and go, this isn't really the kind of trust we're after. Never mind. This one is exempt. So it'll be interesting to see if Canada kind of does that as well.
Yeah, because right now they're limiting to formal ones, right? So where there's written documentation to support the trust, which these would have,
mm-hmm.
Those are the ones that are requiring it. So if it's informal,
yeah,
they're not asking for anything at this point in time. I think my bigger concern with a lot of the increased compliance on the Canadian side is the penalties and a much more willingness on the CRA side up here to assess penalties. So in the past, they quite often, yeah, they didn't, they would maybe assess them, but they would walk away from them pretty easily, right? Hey, you know what, pay the tax and we don't care about the penalties. In the last budget, the finance minister in Canada, he made a comment, and so they've been spending a whole lot more money on CRA. So they're giving them a whole bunch of money, in the name of fighting tax evasion to the underground economy and everything else. But what was interesting is the finance minister said that he expects to see $5 return for every $1 invested. And so either they really believed that the Canadian taxpayer in general is a cheat, or we're going to see them more aggressively going after, oh no, you did this wrong, you filed this wrong, there's a penalty, right? So we're not collecting tax, but the penalties, and that's still going to give them the revenue that they're looking for, and that's my concern. And so again, whenever I'm looking at compliance and stuff, hey, you know what? If we've got a compliance obligation, let's just do it and make sure that we're compliant, and don't even open that door for them to walk into.
Very good. I have another question, and it is from Tom, and he says, are we required to report our ownership of property in Mexico if it is for personal use only? And I think this gets back to the question we had a little bit ago, correct? That I think you said if it is for personal use, I don't want to put words in your mouth, so go ahead and answer that. But I think you said if it is for personal use, no, correct? Just to make sure that's clear.
Correct. If we're not generating any rental revenue from it, we don't have to report it.
Okay.
And the reality is if you're generating some rental income from it, you still may not have to. I would just recommend that you make sure you know that you don't have to.
Gotcha. Another question we have is, so, obviously Puerto Morelos is in this restricted zone, and because of that, a Fido Comiso trust is required. If you own in central Mexico, it's not necessarily required. You can own it in a simple deed. Now, pointing to some other webinars we've discussed why maybe it's still worth putting into a trust for inheritance reasons. But that aside, if we have, maybe it sounds like somebody checked in who maybe owns a property in Mexico, but it's not in a trust. Is there any type of filing requirement there just because it's a foreign owned property?
Yes, if it's not purely personal use, that T1135 reporting foreign ownership, they would have to file.
They would still need to file.
And again, if they were filing, and they would have to have rental income or something generated to have that obligation to file that form, in which case they'd have to report that rental income and that as well too.
Okay. And I have a quick question. Tom has some questions that he'd like to ask. And Tom, I see your mic is green. So your mic is open. I don't know if for some reason it's not connecting for you. But we've got your mic open. So you're welcome to ask a question. And if for some reason your mic isn't working, you're welcome to type in your questions, and I'll make sure we get them answered. While we're doing that and waiting for Tom, does Brad, would you mind, while we're waiting to see if there's any other questions coming in, would you mind putting up your contact information again for us? So that way, if anybody wants to jot that down while we're waiting, they can do that so that they're able to reach out to you. Thanks so much. Appreciated. And again, thanks for joining us. This has been really, really great, and I really appreciate you taking the time to go through it with us. Sounds like it was a good timing. There's some new requirements coming out.
Yeah, it never ceases.
Okay. Tom said we actually got one of his questions answered. It was one that they typed in. It's funny, Brad and I met. Brad, I'm not sure how long ago that's been. Probably 2013 or 14. He and I did
I think it was 2012.
12. Okay, so it was even longer. He and I did a seminar about owning in Mexico. I made the wise decision to schedule a seminar for owning in Mexico in Grand Prairie, Alberta in February, and it was minus 44. I went from Puerto Morelos to minus 44, and Brad was uh, giving his tax advice to Canadians that wanted to move to Mexico there as well. So it's been a while since we've seen each other in person, but I was super happy that he was able to and willing to come on and share some of the updates for us this time. So thanks again, Brad. I really appreciate it. Uh,
You're welcome.
I think that takes care of all the questions. Brad, I am going to steal the presenter baton back from you, if that's okay. And
Yep.
let me share my screen again. Just to kind of wrap up with everyone, if you have any questions, somebody had asked in the beginning of tonight about any questions that you might have as far as new webinars coming up. This is an ongoing series, and I was explaining we do webinars, these online meetings. We've went more and more to those because everybody's able to attend, whether they're in Port Morelos or not. Sometimes we do workshops that are in-house and in Porto if for some reason that's the way we hold them. Although more and more we've went to online. There is an ongoing series of these, and if you want to kind of be in the loop, I try to pick topics that are pertinent to everybody that are living and working and owning in Mexico. And so if you go to portomorelosblog.com, that's our blog, and you can subscribe over in the right-hand column. Any new webinars will always be announced on that blog, so it's a great way to follow. I promise that I don't post a ton of stuff, so your inbox will not be flooded, but we always post our new webinars, any important information, changes in taxes, any big announcements we try to about living in Mexico, we put on the blog. So if you want to, participate in some future webinars, we'd certainly be happy to have you, and that's the best way to track them. My contact information is there. If you have any questions, you're welcome to contact me. In general, the other thing is that, as I mentioned in the beginning, we have recorded this session, and it's going to take us a bit of time to process that video, but we will put it up on our YouTube channel, and we will email you a follow-up email so that you have that email link to the video. So be looking out for that email. It takes GoToMeeting a couple of days to send us the video file, and then we have to process it. So give us a few days. Can take almost a week. The last one because it was a pretty big file. So, but we will be on the lookout for that in your email. And the last thing is that we, do these webinars, and we don't just focus on Puerto Morelos. We focus for any expats that are in Mexico. And so the best way for us to share this is by attendees sharing. So if you see webinars coming up, if you want to leave us, reviews, if you found it helpful, certainly social media is a great way to do it. Share it on, Facebook or, any expat groups or whatever. We certainly appreciate it. And really our goal is just to disseminate some really solid information about owning and living in Mexico. So the more effectively we can do that, the better. And I certainly appreciate anybody that's willing to share our events so that we can have the widest audience possible. So with that, I want to thank everybody for coming in. I'm going to double check that we don't have any last questions. Brad, I wanted to share with you, there's a few chat box. Dawn says, thanks, Brad and Amber. Lots of great information. Tom and Kathy, thanks again. And Susan said, thanks again for doing this, Amber. And big thanks to Brad, por favor. So again, Brad, thank you. I really appreciate you guys joining us. And if you have any questions, certainly you have Brad's contact information. He would be a great source of tax expert help if you are going to need some assistance in navigating these new filing requirements. So with that, everyone have a great night, and look forward to seeing you at the next meeting. Thanks, Brad. Thanks so much.
Thank you.
You guys have a great night.